Okay, so undoubtedly, some of you may have noticed I have a Band-Aid on my nose. I went to my doctor and just talking to her about something else entirely. I'm like, hey, look, there's this thing on my nose. And she gets out her magnifying glass, she looks at it, she says, why, that's skin cancer. I said, whew, nice bedside manner. Okay, she says, that's skin cancer. And she's like, well, maybe not. And so she sent me off for a biopsy. That's why I have this thing on my nose. Now, this leads me to two thoughts that I want to share with you. Number one, always wear sunscreen. Mr. Nylon can tell you back in the 70s and 80s, we only very rarely wore it, and we're dealing with the effects now. And the second thing that I want to tell you is my doctor assures me this will not kill me before the end of the semester. So if you were hoping for one of those everybody gets an A because professor died deals, you're out of luck. Okay, any questions before we get started? Okay, this is where we were at last time. We just got through talking about calculating the cost of equity. Now we're moving on to calculating the cost of debt. And it turns out that it's a whole lot easier to calculate the cost of debt because it is just the yield to maturity on the firm's outstanding debt. It's just the yield to maturity on the firm's outstanding debt. And if the firm only has one bond issue outstanding, then it gets real easy. But if they have others outstanding, then we have to do what's called a weighted average. And I'll do a little, oh, for shame, he's late. Please, nobody tell him why the Band-Aid is on the end of my nose. The curiosity will drive him crazy. Okay, so, we're talking about using the bonds, and we're going to use the weighted average if we don't have a single issue. And what if you don't have any issues outstanding at all? Then you talk to your investment banker. I told you about my friend who worked at Calpine, and he would call up his friend at Goldman Sachs, his investment banker, and the guy was pretty good at guessing about what kind of yield different bonds would require from that company. Okay, now one more thing to note. We use yield to maturity. Yield to maturity is an APR. Technically, scientifically, we would probably be better off to use an effective annual rate. Now, this was started a long time before I came around, and I'm not going to argue with what we do traditionally, so this is how we're going to do it in here. We're going to use yield to maturity, even though there might be a slightly more technically correct answer. Okay, the last thing before I work this little example on the board here is that we have to, oh, for shame, she's even later, but at least she's here today. Okay, so the other thing to remember is that interest is tax deductible. So we're going to have to make an adjustment for that. And that is why, remember back that debt has a tax advantage over equity. Now let's talk about what if the firm has different bond issues outstanding. We're going to call them A, B, and C. And we'll have the following numbers of bonds. For A, we'll have 1,000. For B, we'll have 100. And for C, we'll have 10,000. Okay, and then we have prices for each of these bonds. So I'm trying to make up numbers here that will be easy to do the math. Let's say that these are selling at $1,000. What can you tell me about the relationship between the yield to maturity and the coupon rate for these bonds?
When it's increased, the yield to maturity increases the coupon rate, the price decreases.
Okay, so you've got the relationship down. What does it mean if the bond is selling exactly for face value? We say that they're the same. The coupon rate and the yield to maturity have to be the same, right? Okay, this one is selling at a premium. We know that for this one, the coupon rate must be greater than the yield to maturity. This one is selling at a discount, which means that the coupon rate is less than the yield to maturity. Okay, speaking of yield to maturity, oh, by the way, let's go ahead and we're going to do value here is our next column. And then we're going to have yield to maturity. Now, these bonds all have different covenants, so they're not all equally risky, so don't pay too much attention to these different yield to maturities I put up here. We're just going to say this one is at 6.5, and this one is at 5.5, and this one's at 6. Okay, now, how am I going to find, and we very specifically are doing the market value here. By the way, I could just do the face value times the number of bonds, right? And get the, oh, for shame, he's late, and he winked at me on the way in. I don't even know how to take that. Okay, back to the story. That would be the book value, right? If we take the face value times the number of bonds, but we know that's not what we're looking for here. We always want to use market values. And so the first thing I want to do is take 1,000 times 950. And if my math is correct, that gives me $950,000. Have I messed anything up so far? Okay, now, this one is, we got 100 bonds and 1,050. And so I think that is 105,000, is that right? 105,000? Okay, and then we have 10,000 at 1,000 each, so that's 10 million. Okay, so if I'm looking at this, let's see, if I add 100,000 to that, it gets me up to 1.05 million, 1.055 million. I'm getting 11,055. Is that right? Ms. Durrani says it's right. Did you use your calculator or just your head? Your head. Are you trusting me?
Yes.
Don't trust me. Is it right? Thank you. He has a calculator. Right. Okay. So there we go. That's now the question is, what are we going to do with each one of these? Well, we're going to have to figure out the weight. And the weight for this first one, and by the way, I'm just going to go ahead and I'm not going to include the 0, 0, zeros. Why? Yeah, when I divide these things, they're going to cancel out. The way I'm going to figure the weight is I'm going to take the market value for an issue, and I'm going to divide by this number right here. And so the 0, 0, zeros are going to cancel out. So the first one, the weight is 950 divided by 11055. The weight for the second one is 105 divided by 11055. And the third one is going to be 10,000 divided by 11055. When I calculate those weights, what do they have to add up to? 1. If they don't, the first thing I'm going to check is this number here that I did in my head. And the second thing I'm going to check are the individual weights. Now, the final step here is to get to the yield to maturity for the overall company, and it's going to be the weight on A times the yield to maturity on A plus the weight on B times the yield to maturity on B plus the weight on C times the yield to maturity on C. It's that simple. If you run into one of these. Now, is it possible you run into one of these on the practice or the homework? Yes. Is it likely you will see one like this on the exam? Possible, but not likely. I always like to leave a room open in case I've forgotten what I put on the exam, but it's possible, but not likely. Okay, that's just figuring a simple weighted average. A colleague of mine once said, if you want to flunk everyone in your class, just have them calculate a weighted average. Right? Students hate these things. Okay, so that's how we're going to find out the firm's costs of debt. Any questions so far? Okay, now we have figured out the cost of equity, we figured out the cost of debt, and now we're going to figure out what is the firm's overall cost of capital. So that's going to take into account the amount of our capital structure that is equity, and what is the cost of that equity, the amount of our capital structure that is debt, and what is the cost of that debt. And this formula we come up with is called the weighted average cost of capital, which is WACC. That's what we call it WACC. Okay, now, once again, we're just figuring a weighted average. So the return, the RWAC, which is the overall cost of capital for the firm, is equal to the weight on equity, which is just equity divided by the total assets of the firm. By the way, D plus E stands for debt plus equity. What does that equal to? The total assets, right? And so we're looking at equity divided by the total assets of the firm. That first weight is the proportion of the capital structure that is equity, and we're multiplying it by the required return on equity. The second weight we see up there is the proportion of the capital structure that is debt. It's just debt divided by the total assets. And we're going to multiply that by the after-tax cost of debt. Now you got to be careful here. The after-tax cost of debt is equal to the before-tax cost of debt multiplied by 1 minus t. Because remember, I'm going to put the little t there for the corporate tax rate. Remember that interest is tax deductible. And so our actual after-tax cost is lower. It's just like on my mortgage. My mortgage, because of I can itemize my deductions and get above the standard deduction, then my mortgage interest is tax deductible. Well, if I'm paying 20% my marginal tax rate, that means I'm getting 20 cents back for every dollar of interest that I spend. So my true cost on that interest is only 80 cents instead of being $1. And it's the same thing with corporations. Now, what is this before tax cost of debt? Well, it's that yield to maturity that we just got through talking about. Now, why do I stress the difference here? You have at least one problem that is going to give you the after-tax cost of debt. And if you're given the after-tax cost of debt, you're going to drop that in for all of the required return on debt multiplied by 1 minus t. But if you are given the before-tax cost of debt, or the yield to maturity, then you're going to have to go ahead and multiply that by 1 minus t. So once again, we have a situation where reading is as important as math when it comes to getting the right number for the right answer. Do you think I would be so cruel as to include the opposite answer if I give you after-tax cost of debt, and then if you treated it like before-tax cost of debt, that will be another one of the choices, right? That's what we call a close distractor. This is how I know who knows their stuff and who's just guessing, right? Questions? Okay. So here is our WACC example. Our firm is financed 2/3 with debt and 1/3 with equity. And if you wanted to think of it this way, you could say, well, that means debt is equal to 2, equity is equal to 1. What is debt plus equity? 3. And so debt over debt plus equity would be 2/3. And equity over debt plus equity would be 1/3. So that's how we might have gotten to that. Okay, so we've got now 3 pieces of information. First of all, we've got our cost of equity, 15%, and our cost of debt. If you see it written like this is the before-tax cost of debt. If you see it written like this, it's the before-tax cost of debt. In fact, what I'll tell you is, unless I tell you otherwise, the rate that you get is the before-tax cost of debt. Unless I tell you otherwise, the rate that you get is the before-tax cost of debt. Okay, now I am going to plug in here 1/3 times the required return on equity, which we've been told is 15%. And then we also have our weight on debt, 2/3 multiplied by the required return on debt, the before tax cost of debt, which is 12%, multiplied by 1 minus T sub C. Notice we've converted T sub C from a percentage into a decimal. Anytime you're dealing with one of these 1 minus T things, you've got to convert it to a decimal. And when I do the math, I come out with 11%. 5% plus 6% gives me 11%. Now, one thing I want to point out here, the required return on the equity is greater than the required return on the debt. Does that make sense? Why should the equity have a higher return than the debt? Ms. Coulter.
It's more volatile, it's more risky.
Yeah, it's riskier. Remember, we talked about the order in which people get paid at the company. The bondholders always get paid before the shareholders. Therefore, their position is less risky. Therefore, they require a lower return. So it makes all the sense in the world that the required return on the debt is less than the return on the equity. So now let's talk about different kinds of riskiness in projects. By the way, if you're a firm, the projects that you undertake may have different levels of risk. If the project you're planning to undertake is exactly as risky as the overall firm, then it's perfectly fine to use the WACC as your required rate of return. Let me say that again. If your project is exactly as risky as the overall firm, then it's perfectly fine to use the WACC as your discount rate. I'll give you an example. Right now, we're really concerned about the supply of semiconductors. I've started writing your discussion number 10, and it's going to be about semiconductors and the investment that we're having to make in those. Now, if you are the world's largest supplier of semiconductors, I'm going to ask someone, I think we may have a local expert. Do you know the world's largest supplier of semiconductors? They're from your home country.
Taiwan.
Yeah, okay. But do you know the name of the company?
TSMC.
Very good. I knew he knew. TSMC. By the way, would you like to go to work for TSMC?
Yeah.
Hell yeah. That's like the dream employer in Taiwan, right? Okay. Now, TSMC. The projects they undertake are called chip fabs, which are basically big factories for making semiconductor chips. And if that's the project, they would be perfectly fine to use the weighted average cost of capital. Now, what if they were doing something way out there and wacky? For instance, they were not using the normal silicon base. Instead, they were doing something weird where they were going to use light inside the chips instead of electricity. By the way, they're working on this. If they were going to do something like that, do you think that is the same amount of risk, more risk, or less risk? It's got to be more risk, right? And as a result, you would need to have a higher required return. I'll give you another example here. How about the automotive market? For 100 years or so, what has been the primary means of getting your car down the road? Yeah, gas, internal combustion, right? Where we're burning gas or diesel to get it down the road. What's going on now? Yeah, the electric vehicle. Now, the big question is this. Do you think, so Nissan, I had a Nissan Altima, by the way, totally boring car. Had an internal combustion engine, it had a proven transmission, the market segment was known, right? And so with all those things, if I were going to build a factory to build Nissan Altimas, it would be perfectly fine for me to use Nissan's overall weighted average cost of capital. But now Nissan is making something called the Aria. And they've misspelled Aria, just I guess trying to be cute. That's how they spell Aria. Okay, now, the Aria is different. Any guesses on what the power source for the Aria is? Come on, it's easy, right? Yeah, it's electric! Now, let's talk about the different risks with this. First of all, there's technology risk. What kind of batteries are typically powering electric vehicles today?
Lithium-ion.
Yeah, lithium ion. And what do we know about lithium ion batteries? They have a tendency to explode. Yeah, they have a tendency to explode. They have what's called thermal runaway, where they just, and you've probably seen it on Instagram, TikTok, or YouTube, where these Teslas blow up and they're a big ball of fire, and there's someone, ha ha ha, watching it burn, standing by their Toyota Corolla, right? Okay, now let's think about the design of an electric car. First of all, we know that batteries are heavy. And if anybody else an engineer in the room here? So one of the things that you do when you're designing a car for handling purposes, so it'll get around the curves better, is you put the weight as low as possible. You want the center of gravity to be as low as possible. The batteries are heavy. So where are we going to put the batteries in the car? On the bottom, right? And we're going to spread that weight out underneath the entire floor pan of the car. Now, let's talk about risk here. We've got your seat sitting directly on top of a battery that has a tendency to catch fire. Talk about your chestnuts roasting on an open fire, right? That's some risky stuff. Now, not only do we have technology risk, we also have the risk of market acceptance. Do we know what the market for electric vehicles is? No. So far, there have been government subsidies that are distorting market demand. And what's been happening to the demand for electric vehicles in the last 6 months? Oh yeah, you can't sell those things. We've gone from people waiting 2 months for them to having 6 months supply on the lots. So we've got all these different things. Oh, and by the way, there's also regulatory uncertainty. Right? The Biden administration was saying, oh, you folks need to get rid of that internal combustion, and then recently they kind of loosened up on that. And so if you made your investment based on Joe Biden saying that you're going to have to go electric, maybe you're starting to regret that. And so there's all sorts of risk. As a result, if Nissan is looking at building an Aria plant versus an Altima plant, what should they do with the required rate of return? Should it be higher or lower? Yeah, it's got to be higher because it's riskier. Now, what are the ways that we can figure out for our project that is not as risky as the overall firm? What do we do to figure out our required return? Well, the best way is to find a pure play firm in the field. So, assuming that there's already someone out there doing this thing that you want to do, then all we have to do is look at that firm's cost of capital and then use it as a required return for our project. Now, pure play means that they're really only in one line of business. Can someone tell me a pure play electric car company?
Yes, Rivian.
Yeah, so we used to would have said Tesla, but what's Tesla doing now?
Semis.
So they're doing semis, they're also doing a lot of solar, right? And they're doing those batteries for energy storage. They're doing all sorts of stuff other than electric car companies. So it's no longer a pure play. Someone mentioned Rivian, right? Now, Rivian, have you been keeping up with Rivian?
Yeah, I just saw it.
They look
That was
like
gonna
they got
explode
it
and be done in the next 5 years.
Yeah. So they're basically selling. They're losing what between $35,000 and $65,000 a truck that they sell. And how are they going to make up for that? Volume. Okay. So long story short, Rivian would be a pure play example, and you might be able to figure out their weighted average cost of capital. But there might also be a mismanagement premium involved in that required return. What I'm getting around to tell you here is that it's really hard to find a pure play firm to compare yourself to. It's really hard to do that for your project. And in fact, the example I gave earlier about TSMC, there's nobody out there right now making chips that use light instead of electricity, right? There's no way to find out. There's no way to know. And so what do? Well, some firms have this bump up or bump down. So you bump up the rate for riskier projects, you bump down for safer projects. So let's say our overall weighted average cost of capital was 9%. For risky projects, we might require 12%. And for safe projects, we might require 6%. Now, let me tell you exactly what this leads to. By the way, where we're headed is net present value. And net present value, we said, is just the sum of all the future cash flows of the firm subtract the initial investment. And the present value, we know, of those future cash flows is divided by, let's see, future value divided by 1 plus r to the t. The larger I can get this present value of a future cash flow, the more likely my NPV will be greater than 0, and the project will get accepted. By the way, do managers want their projects to get accepted? Absolutely they do. Okay, so what are managers going to argue? Managers are always going to argue that my project is safe. Why are they arguing that their project is safe? Because they want to get credit for that lower required return. It's going to give their future cash flows higher present values. Therefore, their project has higher net present value. Therefore, it's more likely to get accepted. Now, we know that people are scumbags. I remember going into these meetings. I was young and naive, and I was still telling the truth mostly at that point. Mostly, right? Because I'm still a scumbag, but I'm a low-order scumbag. And I would go into these meetings, and if my project was riskier, I would say so. But everyone else, and they would usually get me to go first, right? And then everyone else is like, oh no, my project's safe. I remember this one guy in particular, his name was Jason. And he would just lie his ass off. He'd have some far out, fantastic, weird thing that he wanted to do. And he's like, oh, but it's totally safe. Why is he doing that? Because he wants the present value of his future cash flows to be greater, so it's likely that he'll have a positive NPV so he can do his project, right? By the way, one of the things about being in industry and working on these projects is you get to tinker with other people's money. Does that sound like an agency problem? Oh, yeah. Yeah. So when I was in industry, people would give me, I had signature authority just to go out and spend $10,000. And I had projects that ranged up into the millions. I was able to do lots of fun things with other people's money. Now that I'm a professor and I don't get those opportunities, what do you think I do? Got a 3D printer. It's really a much lower order of tinkering I get to do these days. Okay, so we've said that managers are scumbags. They want their project to get accepted. That's why they're going to make the argument that it's less risky. So be on the lookout for such scumbags. Now, here's another problem. And this is actually worse than the bump up, bump down. And that is the fallacy of using a single discount rate. If I say at my firm that all the projects have to produce basically the weighted average cost of capital, that sounds good, and it would be fine as long as all the projects were identically as risky as the firm. But we just said that there are some projects that are safer and some that are riskier. And we end up with a situation where we can be rejecting good, profitable projects and accepting bad, unprofitable projects. So let's talk about how this works. If you're looking at this graph, the bottom is the beta of the project. Remember, beta is a measure of risk. And that blue line is actually the security market line. And any project that shows up over the blue line, that's greater than the blue line, should be accepted because it's producing more than the required return for the given risk. What about projects that fall below the blue line? Well, they're negative NPV projects and they should be rejected. And so if we're doing this right, we will be going according to the blue line, the one that's at an angle. But what do we see a lot of companies do? We see a lot of companies just require the weighted average cost of capital of every single project. When I started at Halliburton in 1994, that rate was 11.9%. And it didn't matter how freaking crazy your project was or how safe it was. 11.9% was what you had to bounce it against. Now, let's talk about what that did to our capital budgeting process and what it did to our assets overall. So I'm sitting over in Dallas, Texas, and I have this operation, and we are making safety valves. And the technology that we are using is 100 years old. It's just springs and seals and just very basic stuff. And we have a proven market for that. Meanwhile, over in Fort Worth, Texas, we had an operation that was creating what are called logging tools. And you may be thinking about like chainsaws and crap like that. What we're talking about is a tool that you can run down a hole in the ground and figure out where the layers of oil and everything else is at. In fact, one of our tools, we had a neutron generator, and it would generate neutrons, and then they would bounce back, and it reads the reflection, kind of like radar, and it would tell you exactly what was down there. Now, unfortunately, we figured out later that you could use these things for an atomic bomb trigger, and we had sold a bunch to the Libyans, right? Oh yeah, we got in big trouble. But long story short, we're not in that business, or they're not in that business anymore. But what I'm getting around to telling you here is, do you think the stuff that they're doing over there in Fort Worth is riskier or safer than the stuff we were doing in Dallas? That was riskier. So here I would be over on the left-hand side of this, and my projects had low betas, and my project might be this one on the left. It's above the security market line, but below the weighted average cost of capital. As a result, my project under the corporate standard would be rejected. However, it was truly a positive net present value project. Now, what about the projects from over at Fort Worth? Well, they would come in higher than the weighted average cost of capital, but below the security market line. And so in truth, they were negative NPV projects, but they would get accepted. Now let's talk about the two impacts of following this kind of thought process. Number one, you are going to be increasing the riskiness of your assets over time. How do I know? Because we're going to be continually rejecting safer projects and continually accepting riskier projects, right? And there's nothing wrong with your assets becoming increasingly risky over time as the return goes up accordingly. But that's not what happens in this situation. Remember, we said that these projects over on the right-hand side are not profitable. We are rejecting profitable projects. We're rejecting profitable projects. We're accepting unprofitable projects. As a result, we're actually going to be lowering our return, right? For as far as risk-adjusted return, we're going to be lowering it. Now, if I'm raising risk and lowering return, is that good for the shareholders? No, that is not good for the shareholders. Remember, shareholders are happy if our risk and return go together, but these go in the opposite directions. Now, at this point, you might be saying, certainly, the only reason that Halliburton was doing that was because it was a bunch of stupid oil field people. They didn't know any better. But that's not true. I'll give you an example of another corporation you probably heard of before.
So were they doing it for the purpose just to raise the value of their stock? I mean...
Oh, why would they do this?
Yeah, because I mean, if this isn't new. I mean,
Oh,
if
no.
it was around then,
Oh,
they would have easily known this.
Yeah.
They had to be doing it on purpose.
Oh, okay. Let's stop right there before they were doing it on purpose. Sometimes we know things, but we don't do accordingly because we don't want to put in the effort, right? Did I know going out in the sunshine without sunscreen was potentially dangerous? My wife tries to get me to wear a hat all the time, and what do I say? Nah, right? I started losing my hair on top. She said, okay, now you're going to really have to wear a hat. Do you think I wear a hat? No, right? Did I know I should be wearing a hat? Yeah. Does it start to make sense? So, by the way, one of the things that you try to do in business is avoid arguments. And that's one of the things we try to do here at the university. And I didn't understand it when I first got here. We talked about, basically, we were against merit raises. It's like, as a coming out of industry, it just drives me nuts to think, because to me, if you do a better job, you should get a better pay raise, right? After being here several years, I know now why people are against it, because it just leads to such terrible, terrible fights over such small stakes, right? And so you see the same thing in industry. And everybody's going to be making the argument, my stuff's safer, my stuff's riskier, and then someone finally says, you know what, forget about it. We're just going to require everybody to meet the corporate cost of capital.
But they're losing money that way. I mean,
Oh, yeah.
There had to be an advantage in some way to do it other than.
Okay, remember the agency problem.
Fight.
Remember the agency problem. Whose money is being lost?
Yeah.
The shareholders. Who is enjoying the lack of fights?
Okay.
The managers. Do you see that? Yeah. And I'll take you one further. I was getting ready to tell you about another company here. You've probably heard of it, Walmart. Right? Now, Walmart, by the way, we're sitting in David Glass Hall. David Glass was CEO of Walmart. He was around in the beginning at Walmart, and he's one of our graduates. Now, this is a fine institution, but it's not Harvard, right? And now, when I worked at Walmart General Corporate Headquarters in 1993-94, they had Harvard MBAs there. And they had started, because the company had gotten big enough, they started hiring these people in. Now, not too long ago, I was up in the dean's office, and I ran into one of our alumni. And he introduced himself, and he said he was the vice president of the customer experience at Walmart. And I'm like, oh man, that's like being Satan, because if you're in charge of the experience in hell, you know, we can, okay. So Walmart's a fine corporation, but I do get a little weary inside their stores because of the people in the pajama pants, right? Okay, back to the story. I said, oh, well, I wouldn't have any thing to inform you. You know, I wouldn't have anything that I could say that would be helpful to you. He says, on the contrary. He says, I have to send every one of my projects to the finance people to make sure it clears the hurdle rate. I said, did you just say the hurdle rate? He said, yes, I did. I said, what's the hurdle rate? He says, you know, the corporate cost of capital. Walmart, Fortune 500 company, largest private employer in the world, if I recall correctly, does this. Now, I just got through telling you that they had Harvard MBAs working there, which tells me now that your MBA from Missouri State is better than a Harvard MBA because you know this stuff and apparently they don't. Questions? Okay, now let's talk about flotation costs. People often get confused about the interaction or lack thereof between flotation cost and the weighted average cost of capital. So when we talk about the weighted average cost of capital, we're talking about the return required based on the risk. But when we're talking about flotation costs, we're actually talking about the cost to raise money. Remember when we talked about sinking funds back in Chapter 5? We said that that was money that was set aside to sink the bond issue, and that's basically to pay it off. The opposite of sinking is floating. So when we're issuing new debt, we call that a flotation of a bond issue, or we can have a flotation of new stock. When you do that, you have to hire someone called an investment banker. And the investment banker, here's how it works. They actually will buy the securities from you and then turn around and sell it out to their retail network. And then they sell it, actually, of course, they sell it for more, right? And so now we've got this retail issue out here, and there was a discount to the, the amount of money you receive is small compared to what they actually received from the investors. That difference is the flotation cost. And typically, we're talking, I think it's around 7.5% for stock. It's around 7.5% for stock. Now, it's actually higher when you go out to raise stock than when you go out to sell bonds. And here's why. It's called inventory risk. Remember I told you that the investment bank is buying this stuff and then they're turning around and selling it? Well, in the time that they are holding on to it, they have an inventory. And if the value of that inventory goes down, they can end up selling it for less. I'll give you an example. A phone company called Vonage. This is back when broadband internet was first coming around and people were like, well, hey, we can dump our telephones and we'll just use the internet. And there was a company formed called Vonage to take advantage of that. Now, my wife and I see the ads on television and I said, you know what? That business model has no competitive advantage. So there's no one in that business has advantage over anybody else. So basically anyone with the right amount of money can go out and buy the servers and make the deals with the phone companies for the interconnections. Anyone can do that. And I was shocked that the market overall didn't see that. And so, or actually the investment bankers didn't see that. And here's what they did. They went out and they bought the Vonage shares for like $22 a share, thinking they're going to turn around and sell them for 25 or 26. But when they turn around to sell them, it turns out that the rest of the market had figured out what I already had, and that is that this wasn't worth what they thought. And so people were only willing to pay, say, $17 a share. And so the investment bank ends up losing money. Now, it's a rare occurrence, but it does happen. And as a result, since there's risk, then we have to have the higher required return. Now let's think about bonds and how bonds are different. First of all, bonds have a set pattern of payments, right? They pay a coupon every 6 months and they pay the face value at the end. And so the only thing that can really change on them that might make this worth more or less is basically changes in the underlying interest rates of the economy. And so basically you're looking at interest risk or price risk there. That's much less than trying to guess what is the future growth rate of the cash flows for the stock and all that other kind of stuff. Okay, now, as a result, a lot of people will say, hey, wait a minute. Since it's cheaper to raise debt, we're just going to fund everything with debt. Is that a good idea? No. Here's what we know from capital structure theory. We actually, from the empirical evidence, we know that firms in the same industry tend to have very similar capital structures. What that leads us to believe is that for a given industry, a given capital structure is probably ideal. So if we look at different kinds of firms, we can see different capital structures. For example, if you look at a biotech firm, biotech firms are out there trying to discover the cure for cancer and whatever else, and here is their business model. They lose money, lose money, lose money, lose money. By the way, are the nerds that they hired cheap? No, these are expensive nerds. Lose money, lose money, lose money. And then, woohoo, they find the cure for Parkinson's disease and sell it for a bunch of money. And then what happens the very next quarter? Lose money, lose money, lose money, right? Would you loan money to these people at all? No. They have to be financed 100% equity because they would go bankrupt after the first quarter otherwise. Okay, now let's talk about another kind of firm. In fact, let me ask you this question. Would you loan money to a firm that runs on 90% debt? Would you personally loan money to a firm that runs on 90% debt? Mr. Spencer says no. Spencer Ingram says no. Why?
Because if it's 9% debt, those people are probably going to want to get paid first. They have a lot of they already have a lot of commitments.
Right.
Previously.
Very good. Now, I'm going to ask you, since you've started on this path, I'm going to ask you, do you have a bank account? You do. Well, guess what? You are lending money to a place that runs on 90% debt. in the United States and pretty much around the world, it's interesting. Even regardless of the different laws in different countries, we see that banks typically are running at 10% equity, 90% debt. Now, why is it possible for a bank to do that? It has to do with the nature of their assets. Is all their money loaned to one borrower? No. Is it even loaned to one industry? No. It's a diversified portfolio. Here in the United States, they're not even allowed to have more than 10% of their investments in a given industry, I believe. Okay, now, what does that mean for those assets? They're actually fairly safe. And the safer the assets are, the more debt they can take on. And so that's why we see banks running at 90% debt. In fact, the ROA at banks is like 1%. You say, wow, that really sucks. But when you multiply it by the equity multiplier, it brings us up to around 10%, right? And then that's starting to sound okay for ROE. Okay, now, why do I tell you about those optimal capital structures? Because if you are already at your optimal capital structure, and then you issue debt to fund every new project, you are going to move further and further away from that target capital structure, right? You're going to become higher and higher debt-to-equity ratio. You're going to be moving farther away from it, and you are going to be taking on too much expected cost of financial distress compared to the tax savings you get. Those are the things you're trading off there. So we say whenever you go out to raise equity or debt, we are not going to say, well, just because I'm raising debt this time, I'm going to use that flotation cost. We're going to come up with a different way to handle that. But I want to tell you this about flotation costs. You'll actually see some finance textbooks where they say we're going to add the weighted average flotation costs as a percentage to the weighted average cost of capital. Folks, those people have no idea what they're talking about. That is absolute garbage. That is absolute garbage. And here's why. Remember, weighted average cost of capital is an ongoing expense. What about the cost of the flotation costs? It's all up front, right? It's all at time zero. If I go out to raise $100 million, sell $100 million worth of stock, I receive $92.5 million of that, and the investment bank keeps $7.5 million. That is a time zero cash flow of minus $7.5 million. And so the way we're going to deal with flotation cost is as a time zero cash flow, not as a percentage. It's not related to WACC. It's not related to WACC at all. Questions?
Can firms derive a competitive advantage based on their capital structure?
Actually, I believe they can. So if you think about, first of all, if you're not at your ideal capital structure, you are leaving money on the table, the tax shield, right? If you've got too much equity, not enough debt, if you're not optimal. What if you are above that level? Then basically you are experiencing too much expected cost of financial distress. You are getting some additional tax benefits there, but it's still a bad deal. And so you're better off if you are at that capital, the capital structure. Now, as far as in the product market, I don't know. That's a good, I don't think that there's any impact on that, but there might be, especially if you were undertaking financing of purchases for your customers. If you had a solid balance sheet, then you might be able to do that. Whereas if you had too much debt on your balance sheet, you might not be able to. Does that make sense?
I would think the capital structure would also drive the business model as well, which could differentiate you in that respect as well.
Okay, so what you're saying is the capital structure drives the business model. It's actually the other way around. What you do is you look at what business you're in. So remember last time we talked about the business cyclicality, and we talked about the operating leverage. The business cyclicality is the overall business you're in, and then the operating leverage has to do with how you're basically setting things up to handle that. And those are the things that are going to drive your investment decisions. And so, and then we have to turn around and look at how we're going to finance that. And that's based on the overall industry, once again, determined by the business that we're in. And so the capital structure is an outflow of the business that we're in, not the business that we're in, an outflow of the capital
Yeah, that
structure.
makes sense. I mean, so in other words, you can change your capital structure in that same industry by changing your business model, if you can somehow improve that model.
Hey, you
What
could,
the
so let's,
Industry standard model is.
let's talk about car companies. Car companies were just in the car business, and then they start to get into the financing business. As a result of getting into that new line of business, they could probably carry more debt on overall, because now they were in this industry where high debt was the norm. So yeah, you're absolutely right. By choosing to get into a different line of business, you could change your capital structure and still be optimal. Okay, now we said that regardless of how we go out there and raise the money, we are going to use the same weighted average flotation costs. And here's why. Remember, we said that debt is cheaper to raise than equity. And so people will always argue for their project to be funded with debt because it makes their time zero cash flow less negative, and it makes their project more likely to be accepted. And even if you go out and finance that with debt, here's what happens the next time. By the way, I'm always the next guy. The next guy that comes in, and I'm like, yeah, I've got this great project. And they're like, well, sorry, we're going to have to fund this one with equity. And I'll say, why? They say, well, we funded the last one with debt. If we want to keep our capital structure in the same way, in the same target area, we have to do the next one with equity. And sorry, guy, you're it, right? And so my flotation costs are going to be more negative, and my time zero cash flow is going to be of a greater negative magnitude. And so my NPV will be lower. In fact, it might come in negative now. And I'm like, wait a minute, how in the world is that fair? The answer is it's not. And so what do we do to make sure we're not advantaging or disadvantaging projects? We just use the weighted average flotation cost based on our current capital structure. We just use the weighted average flotation cost based on our current capital structure. That way, no one's going to get an advantage or a disadvantage based on how they assume the project is going to be funded. Questions? Okay, now we have another formula. By the way, did you write down, did you know that on your note sheet you will need the weighted average cost of capital? I forgot to mention that, right? You need that. And in fact, if I were you, under that R sub debt times 1 minus T, I would write after-tax cost of debt so that that's in your mind. Okay, now we have another weighted average, by the way, another one that you'll need to have on your formula sheet. And this one is the weighted average flotation cost, which is F sub O, F sub 0, is equal to, that first weight is exactly the same as the first weight for weighted average cost of capital, which is the proportion of capital structure that is equity. And we're going to multiply that by F sub S, which is the flotation cost of stock. The second one is the proportion of the capital structure that is debt. And we're going to multiply that by the flotation cost of bonds. And remember, we said the flotation cost of stock is going to be higher than the flotation cost of bonds. Notice that there is no 1 minus T sub C here. The tax impact of both of these are identical. There is no tax advantage flotation cost-wise to issuing bonds versus stock. There is one more thing, though, that you need to know. Remember back when we talked about if we're making net income and we're not paying it all out as dividends, where does that money go that's left over? Retained earnings, right? And we said that retained earnings becomes part of your internal equity. If I am using internal equity, the flotation cost for my internal equity is 0. The flotation cost for my internal equity is 0. And at that point, the flotation cost for equity becomes less than that for bonds because all debt must be raised externally, but we can raise equity internally. So let's give you an example here. Apple. Is Apple profitable? Oh yeah, they make a boatload of money. Do they pay it all out in dividends? I think they pay too low of a dividend. As a result, what does it mean for their internal equity? Yeah, it's high, right? They're sitting on a huge old pile of cash. Do you think Apple considers themselves to have a positive flotation cost for equity or zero? Yeah, I would go with zero. I don't remember the last time Apple issued stock, right? And so they're using internal equity, so their flotation cost for stock would be zero. Now, what's it going to do to your overall average, weighted average flotation cost if your equity cost is zero? It's going to lower it, isn't it? And that comes back to the competitive advantage question you asked earlier. If you can fund your equity internally, then that's an advantage because your flotation costs are lower. Okay, so let's use an example here. And we're going to start out talking about percentages, and we're going to end up talking about a dollar amount. And that dollar amount is going to be a time zero cash flow. So your equity, or your company is financed half with debt, and the flotation cost for this debt is 5%, and half with equity, the flotation cost of which is 15%. So in this example, we might think D is equal to 1, E is equal to 1, and D plus E is equal to 2, and so that's how we get those weights. So what's your weighted average flotation cost? Well, we've got our formula there. Oh, by the way, we're going outside to raise this money, right? If we were using internal money, what would our flotation cost be for that stock? It would be zero. Okay, so we've got half of the 15% and half of the 5%. We add those together, it gives us 10%. Now, let's think about what does that mean in reality. If I go out to raise $100 million, I'm going to have to pay 10% of that money to the investment bank. 10% of 100 million is 10 million bucks. So after I get through paying that 10 million bucks to the investment bank, I'm only going to have $90 million left over. That's what that means. And so if I'm going to have to raise 100 million to get 90 million, if my project is 100 million, I'm going to have to raise more than $100 million. I'm going to have to raise $100 million plus the amount that goes to the investment bank. And those two things added together are going to be my time zero cash flow. So let's talk about how we get there. We talk about the amount that we need. That is the 100 million. That's the amount that I actually need to make the investment. And then I have the amount that I've got to go out and raise. And if my flotation costs are non-zero, then I'm going to have to raise more than I actually need. And how much am I actually raising? I'm going to have my amount raised, and then I'm going to have to multiply by 1 minus my weighted average flotation cost, converted from decimal, and from percentage into a decimal. So here in our situation, we know that f sub 0 is 0.1. And so 1 minus 0.9, 1 minus 0.1 is 0.9. So we know we're going to have a 0.9 in there. How am I going to then calculate the amount that I actually need to raise? I just do a little algebra magic. I divide both sides by 1 minus f sub 0. And that means I'm dividing both sides by 0.9, at which point I can now see that my amount that I need to raise is 100 million divided by 0.9, or 111.111111111 million. How much of that is actually the flotation cost? All I do to figure out my flotation cost is take my amount raised minus my amount needed. I have to go out and raise 111.1111111 million, and I only need 100 million, therefore my flotation cost must be 11.1111111 million, right? Does that make sense? Okay, now what do I put down for my time zero cash flow in my net present value project? Well, I put in minus 111.1111 million because it's the amount that I need for my investment and the flotation cost. So it's both of them together. In other words, it's the amount that I raised, not the amount that I need. Now, you say maybe it won't make a difference. Let's say we've got a project with a net present value. If we don't include the flotation cost, the net present value is positive $5 million. Under our NPV rule, which we talked about in Chapter 4, do we accept or reject the project? We accept all positive NPV projects, remember? And so this is a project we would accept. But then, once we consider the flotation costs, what happens? Well, now instead of being positive 5 million, we're negative 6.11111 million. And if it's a negative NPV project, do we accept or reject it? Yeah, we got to reject it. And so it can make a decision, it can make a difference in your decision whether you're going to make the investment or not. And this is where it comes back to, can your capital structure give you an advantage? If you're working from internal equity, then your flotation cost is less. You could take on the same project as a competitor, and you could get to positive NPV when they were suffering from a negative NPV, and they wouldn't get to make the investment. So yeah, you can get an advantage out of your capital structure. Okay, now let's see. I think that's all I want to tell you about that. Any questions? By the way, if you think in your head, what kind of a car does an investment banker drive? Mr. Ingram had a smile on his face. What comes to mind?
Bentley's come to mind.
Oh, Bentley, very good. Okay, usually someone will just throw out Mercedes, and I will say, not a very successful one, right? In fact, the biggest day for sales for Ferraris in the Manhattan dealership is the day that the bonuses on Wall Street come out. And who are the people getting those bonuses? Investment bankers. Why are flotation costs so high? Because investment bankers have to drive Ferraris, right?
Mm-hmm.
Okay. Now we're on to Chapter 7. What's the goal of financial management? Maximize shareholder wealth. Everything that I do at the company, I need to ask myself, am I maximizing shareholder wealth? And so when we go out to make investments, we need to have rules to decide which projects we should take on and which ones that we should walk away from. And all of those rules should be pointing us toward maximizing shareholder wealth. And in fact, when I'm talking to potential students, these freshmen that come in, and I say, well, what are you planning to major in? They say, well, either accounting or finance. And then I say, do you know the difference between finance and accounting? And they say, first of all, they don't want to admit that they don't know. Well, I say, it's okay. I say, here's the difference. Accounting is all about recording what happened in the past based on a bunch of random rules developed by a bunch of old white dudes. That's accounting, right? Finance is about making decisions about what you're going to do in the future based on immutable laws of mathematics in place since the founding of the universe. Which one sounds better? Finance is sexy, accounting is not. And so it's this sexiness, though, that leads us to have these decision rules. We've got to figure out what we're going to be doing there in the future. And we're going to talk about a bunch of different rules. And we're going to show you that one rule rules them all. But we are going to show that in certain situations, these other ones might have a place. These other ones might have a place. So even though, I'm going to spoil the ending for you here, we know NPV is the best measure out there. There are other measures that have something to be said for them. So what makes a good investment rule? Number one, it accounts for the time value of money. Do we know that there is time value of money? Absolutely. If I asked you, would you rather have $1 today or $1 a year from now, what would you say? Now, right? We know that's true. And also accounts for the riskiness of the cash flows. We know that riskier undertakings have to have higher rewards. I think I told you about my hometown. We had 3 industries: dynamite, bed springs, and cheese. Which one of those do you think was the most dangerous? Dynamite. Which one do you think paid the most? Dynamite. Does that make sense? We know, instinctively we know. So, one more example. It was after I left Halliburton. They had truck drivers in Iraq working for the Army, right? Carrying stuff. And $40,000 a year was about what truckers were making in the U.S. at that point. Can you guess what a truck driver in Iraq was getting paid?
6 digits, over 100.
Yeah, it was over $100,000. And by the way, people who couldn't get a license in the U.S. to drive because of whatever, were they driving in Iraq?
Yeah.
Absolutely. Now, why?
For combat zone.
Yeah, it's risky. In fact, one of our drivers, they found him in a shed. Actually, they were keeping him in a shed. They kidnapped him. They were keeping him in a shed, and they were feeding him applesauce through a garden hose. And he finally managed to bust his way out and run to the convoy down on the highway, right? Do you think that deserves extra pay? Yeah, even a guy that dropped out of high school and can't even get a CDL, commercial driver's license, is smart enough to know that if I'm going to go to Iraq and drive a truck, you damn well better pay me a whole lot more money. Okay, now finally, providing information regarding the wealth created by the project. And here's why that's important. I've already asked you this today, so hopefully you remember the answer. What's the goal of financial management? Maximize shareholder wealth. If my rule is not telling me about whether the project creates wealth or not, how do I know that I'm maximizing shareholder wealth? The answer is I don't. Okay, now we're going to start out with net present value. And it is simply the sum of all the future present values of all the future cash flows, including the time zero cash flow, where the cash flows in are positive and cash flows out are negative. And the answer, or if we come out greater than 0, we undertake the project. If we come out less than or equal to, we reject the project. Now, that's very simplistic. For purposes of this class, that's absolutely correct. For purposes of the real world, we'll get to in a second what we need to do here. Now, why do we accept these positive NPV projects? Because doing so increases shareholder wealth. And the goal of financial management is to maximize shareholder wealth. So the rule of thumb is accept all positive NPV projects. And you say, wait a minute, we might not be able to fund all positive NPV projects. One of the things that the theory behind NPV assumes is that if you've got a good project, you can always get funding. And I'm going to show you some evidence on that. It's actually fairly accurate in the United States, may not be so accurate once you get out into other capital markets. Now, remember I said for purposes of this class, accept anything greater than 0. In reality, let's use a little common sense. So, you've got 2 projects that both have a positive NPV of $12. The rule says what? Accept them both. Now let me give you another piece of information. One of them has an initial investment of $100. Do you still feel good? Yeah, I'm putting $100, I'm going to get $112. Yeah, I'm good. One of them costs $5 billion to invest in. The rule says to invest, but you're saying, maybe not. Right? All I have to do is to have underestimated my initial cash flow by $13. Right? And now I've got a negative NPV project, and I've got $5 billion invested in it. So, use a little common sense when it comes to such things. Let me tell you, and I told you about the dangers of thinking that beta is a solid, perfect number. I showed you the pictures, right? We're just coming up, we're figuring it out through linear regression, and we know that the fit's not perfect. Let's think about what we know that goes into net present value. Well, there are the future cash flow amounts. And those future cash flow amounts are based on at least two numbers. Number one, the price of the thing that we're selling, and number two, the amount of the thing that we're selling. How do you know this information? Let me ask you this question. Do we actually know this information? No. In fact, all of that scientific wild-ass guess, right? And the kind of people that give us these numbers are called marketing people. Raise your hand if you're a marketing person. Don't be shy. Do you consider yourself an optimist? Yeah! I never get pessimists from marketing. Now, what do you think that means for their thoughts on what we're actually going to be able to get per unit? Probably high. And what do you think it means for their estimate of the number of units that we'll be able to sell? It's going to be high too, right? So, do we know that number? No, but we know it's whatever they give us is probably high, right? Kind of like they are. So, let me tell you, I actually worked with a marketing guy named Bob. And Bob was actually a great marketing guy because any number that he gave me, all I had to do was reduce it by 20%, and I had something really close to what was going to happen. Now, Bob didn't realize that he was a genius, right? Because he was always, in his mind, always wrong. He would say, oh yeah, we're going to sell 100,000 of them. And as he walks away, I'm like, 8,000, right? Okay. So that's your first guess. Now, what about expenses? Let's say you're doing a trucking company. What's one of your big expenses?
Yes.
Gas or diesel, right? What's another big expense? Labor, right? Maintenance, labor. Do you think we know these with certainty? No. We could have some sort of freaking war break out. Russia could invade someone else. And once again, what's going to happen to diesel prices? They're going to go up, right? Or what if things get frisky in the Middle East and someone nukes the oil fields there? Now the oil is all radioactive. You guys want to put that in your car? No, you're going to be willing to pay a premium for that West Texas Intermediate, right? Whoop! We can't tell the future with certainty. And so students get this NPV and they're like, oh yeah! And then it's like it's a number handed down from on high. It's not. It's a swag that is a result of several other swags. And now you're going to say, well, wait a minute. At least we know our time zero cash flows with certainty. And I used to think the same thing. And here's why. You say, wait a minute. I've got the quote on the machine. I've got the quote on the installation. Here's the next question that you never want to ask. What could possibly go wrong? Let me tell you what went wrong. I had a project to put in a new CNC computer numeric control machine, $700,000. And it had a positive NPV of $25,000. Do I accept or reject the project? You guys can probably tell it's going to go horribly wrong, so you're going to say reject. But the rule says to accept it, right? And sure enough, it made it all the way through the process, and we accepted it. And we got all excited because the big day was here. The machine is already in the shop. It's in several pieces to get it through the door, but it's there. And now we have to have a millwright install it. A millwright is someone that installs machines. And, but we had done all of our homework up front. We read the instruction manual for the machine. It said that we need to have 12 inches of concrete in order to be able to mount this machine. And so we rolled out the building plans from 1962. The place was built on an old cotton field. Rolled out 1962, and it says that the concrete floor in the area where we wanted to drill was 14 inches thick. So we're good to go. Let me tell you what happened on the day that we started to drill the holes for the anchors. Here's what it looked like. The guy has this big drill. He's going, brrr, and the drill just drops. Do you know what happened? We didn't have 14 inches of concrete, we had 4 inches of concrete. And then we hit immediately underneath that good old cotton field, right? Now, why do you think we only had 4 inches when we paid for 14?
Cut corners.
People are scumbags, right? By the way, this story's happening in 1997. The building was built in 1962. Students often ask me if I tracked down the guy that skimped us. And I'm like, what am I going to do? Go kink his oxygen hose in the rest home? So no, you can't. Okay, long story short, we're not done yet. Long story short, what does it take to fix the problem? We spent $40,000 redoing the floor in that area of the factory. Our time zero cash flow was $40,000 more than we estimated. Turns the project immediately into a negative NPV project. Can you trust NPV? No. Should you accept ones that have only a slim margin? No. And what did I do to every project after that? I always included a 10% contingency. If I had done that, my initial cash flow would have been $770,000, and the project would have been NPV from the beginning, and I wouldn't have undertaken it. And by the way, after the 10% contingency, all of my projects came in just barely under budget. What does that mean? It means that all my other projects before that were going over budget. Questions?